Bring in David Zervos, Chief Market Strategist at Jefferies. David, I guess, clearly everybody is in wait-and-see mode. We don't know enough to make real broad conclusions here in terms of what the economic risks might or might be. So kind of easy to say, well, let's wait and see. The market doesn't wait and see that easily a lot of times. It needs to reprice based on what we know. What did today's action tell you along that front?
I think it's difficult to read today's price action. It was a very illiquid day. It was very illiquid in Europe, both in the bond and the stock market. So I think let's watch Monday. Monday's going to be a really critical day. We come off of these sorts of, down 4 or 5% in European equities, 2 to 4% depending on the Russell or the S&P here, and just a lot of people out. I think Monday's going to be a really important day. And I'm a little worried, to be honest, that people have gotten themselves positioned very aggressively for a view that is extremely rosy at valuations that, were pretty darn good going into the end of the year. We were up 26, 27% for the year in the S&P. And, now we pulled back up 23 and a half. Come a long way. And I think a lot of people are pressing and it could be kind of messy. So I'm kind of okay with a little bit of mess here.
Okay with messy just so that it cleans out some of that aggressive positioning, or because you think that, people have to downgrade their assessment of what the economy can give us next year?
I think there's two parts to it. The first part is that I think people have gotten a little ahead of themselves on the whole inflation story and the whole consumer story. Not a ton, but it's going to be more difficult. And you see it in the sentiment data. Nobody wants to talk about the sentiment data, but this is going to dent sentiment once again, and the Michigan sentiment in particular stands at very, very low levels. So I worry about what these sorts of, random hits across the bow vis-a-vis the virus do to longer-term sentiment. That's one. And the second is I just think people got very aggressive in their positioning, and it's nice to see things clean out. You sort of saw this in the bond markets with everything that, was happening with inflation, and you just couldn't get the 10-year note yield up. People just got themselves into a bit of a tailspin here with the fixed income markets in particular. And I think that's probably still got to work itself out. I don't know that it plays that badly for equities because it's more of a bull market story for fixed income, or at least better for the long end. But I like a position cleaning here. I think that's a good, healthy thing for this market.
So when you get calls by Jefferies clients about what to do today, what are you telling them in terms of equity or bond exposure at the moment?
Well, Sarah, we felt like you had a really good run for the first 3 quarters, and it was time to kind of watch and take a break. It was a breakneck pace coming into the fourth quarter, and we were looking for sort of some stability for a little while and just some room to watch how this inflation debate, in particular, and how the Fed debate would line up, and how the Fed makeup would happen with Jay and Lael and others still in the mix for the vice chairs now, but. I think you do have a new Fed. We're not going to talk about Fed too much today. It's not the exciting thing on everybody's agenda, but we have a very different Fed that's coming up. We have a very difficult inflation story to swallow for a lot of people. And we've got this constant shot across the bow of new things coming vis-a-vis the virus. So there's just a lot of things that can get us into a little bit of a messy position, especially if people take themselves to a levered place that they might not really want to be into an illiquid time of the year, such as year end. And so I'm, like I said, I don't see anything huge, excuse me, but I could definitely see a reason why we get a kind of messy couple weeks going into the Fed meeting. I don't have a problem with that.
Yeah, it's interesting, David, and this always is the case, but the way we talk about the Fed and how the Fed is going to change and what the Fed is going to say always vastly exceeds what the Fed itself is kind of saying or has the opportunity to tell us, right? So we've all kind of gone all these different directions of how many hikes there are going to be, whether they're going to tolerate more inflation. In between, when we heard, from Jay Powell in the last press conference and what we're going to hear next time, they may not have to necessarily change their tune particularly much compared to what they've already been saying to incorporate everything that's gone on in the midst of it.
Absolutely. I mean, look, the markets have been pushing them the whole time, and they've been pushing back on the markets. Now you get this kind of virus story. It sort of plays right back into where they've been coming from more, or at least the core of the committee's been coming from. So, I think it adds to caution. It adds to, being a little bit risk averse with getting too aggressive. even at a time when the inflation data does look really, really spicy, especially the last couple prints, or the last print in particular, after we had some had some very weak numbers for Q3, so or at least normal numbers for Q3. So, I'm sorry, go ahead.